This is by far the biggest tax strategy going around right now, the short-term rental loophole. My name's Matt. I'm a CPA that likes to talk taxes and taxes when it comes to real estate. I run a firm called TrueBooks with a team of almost 30 people, and we specialize in tax strategy for real estate investors and small business owners. And I myself am a real estate investor, so I can put myself in your shoes when it comes to maximizing your tax savings while still growing my real estate portfolio. So let's hop into this. Okay, so let's start with what is an STR, right? That is a short-term rental. What makes it short-term? For tax strategy, and what we're going to talk about in this video is we need to make sure that the average rental period of this short-term rental is less than 7 days. But short-term doesn't mean just Airbnb, just VRBO. It could mean that you lease this thing yourself outside of any platform. But when it comes to the tax strategy piece of things, because we need to follow the rules here to make sure that it works, we need it to be less than 7 days for the average rental period. How you're going to find that out? You take how many days the property has been rented for and divide it by how many different reservations you have. That will give you your average rental period. Now, what's our goal with the short-term rental when it comes to taxes? Well, all of us make money at maybe a W-2 job or we run a business, and yet we want to use our investments to bring down our tax bill. And what happens is we're going to make, let's say, 100 grand, and stick around because we're going to go over an actual example to show you how somebody making 90 grand on a W-2 can save a substantial amount of money when it comes to the short-term rental loophole. We make 100 grand here, we can lose 50 grand with our rentals, and at the end of the day, net those two together to ultimately pay tax on 50 grand instead of all of your income being 100 grand. So that's the goal here with the short-term rental loophole. Now, I quickly want to address the term loophole. As a CPA and tax professional myself and peers that I talk with, we don't really like that term because it almost makes it seem like we're trying to do something illegal when we're not. All we and our clients are doing are utilizing the tax code to their advantage to make sure that one, we follow the law, but two, we keep more of the cash that they earn in their pocket. At the end of the day, that's what tax strategy is. That's why I'm here. That's why your tax advisor is there. So what is the loophole? Why do we even need a loophole? Well, we need to zoom out and first see that every dollar you make is either passive or non-passive in the IRS's eyes. And rental real estate, so your short-term rental, is by definition passive income. So like I said earlier, we want to make 100 grand and then lose 50 grand on paper with our real estate, which we'll talk about how. I typically, since those are two different things, the money that I make at my business is non-passive versus my real estate is passive, I can't commingle those two. But if we pass these specific rules, we can then consider all of it non-passive and have it be in one bucket so that we can bring down our income and ultimately keep more cash in our pocket. So that's why we need this loophole and what we found in the tax code to help us avoid these rules that would by definition make our real estate passive. And so some quick examples to help hone in the point. Passive income, a business that you own a piece of but you don't really work within. Let's say a hair salon, you own 10% of a hair salon and it kicks you off some cash because you invested money in the deal. That could be a passive activity. Rental real estate, a passive activity. Non-passive activities are quite the opposite. Anything that you actively participate in, so such as your W-2 job, the business that you run, a business that you've invested in and work in to help drive sales or something like that. So that's the difference between non-passive and passive. Now here's the loophole in the actual code section for my nerds out there on how we're able to do this strategy or a major piece of it. It's Reg Section 1.469-1T E3A2, and it talks about exceptions. For purposes of this paragraph, E3, an activity involving the use of tangible property is not a rental activity for a taxable year if for such taxable year, right? And that's IRS language, you gotta love it. But here's the first bullet point. The average period of customer use of the property is 7 days or less, such as an auto or boat rental. So it refers to other assets as well. And that's the piece of the tax code that we're able to utilize to allow us to get these major tax savings. And so you'll see that since we found an exception to that rule, now we're able to say that this activity is no longer passive and it can become non-passive. But there's still another test that we have to face, and let's go over that. It's called material participation. So there's two major steps to having this strategy work. One is less than 7 days. That allows us to avoid the activity being passive. But two, the IRS says, hey, okay, for you to be able to reap the tax benefit here, we have to see that you are materially participating in this activity and not just investing in it and sort of kicking back with your feet up, collecting a check. So that is where material participation comes in. There are 7 tests to material participation, but really we're only worried about 3. To be honest, as a tax professional, I've never had to use any of the other 4. So we're going to cover the 3 that really matter and that most of you and our clients actually hit. And remember, you only need 1 of them. You don't even need all 3. The first one that we like to talk about, which is more of the gold standard, is 500 hours in the activity of time spent. So a significant amount of time spent on that activity. Well, if we think about it, we're doing this for a short-term rental. It's pretty uncommon that you would need to spend 500 hours of time managing a short-term rental. And so you'll see that typically with that test, you're not going to hit that because you're not going to spend 500 hours on that activity. Remember, activity is the actual rental property itself. So then we move to test 2. Test 2 is 100 hours and more than anybody else. This is the test that most people will pass. And it's because it's easy to hit 100 hours in the property. You buy the property, you furnish the property, you list it on an Airbnb site, you take photographs of it, you have to go back and make some repairs to it, you screen tenants, for your short-term rental stays. So cumulatively, all of that time could amount to 100 hours. But you saw the second piece of that is it has to be more than anybody else. So we get asked a lot if hiring a property manager will blow you earning material participation. And most of the time, 99% of the time, it will. Because a property manager's job is to manage the property. So if you were to sit before the IRS and have to argue, hey, I materially participate in this property, but I also have a property manager, they're likely not going to buy that case because the property manager likely did all the work. So we like to say, if you're going to try to implement this strategy, do not have a property manager involved so that you can make the case that you materially participated in the property, not the property manager or anybody else. But you'll see there that it has a caveat of 100 hours plus more than anybody else. So you can have somebody else do some work on the property, such as a handyman or someone coming to help you furnish the property, something like that. But remember, you'll have to track their time now because you have to prove that you did more time than them. And remember, you just have to hit 100 hours. And the last of the 3 that we like to talk about, which is rarely used, is simply substantially all. You've done all the activity that property took to become up and running and functional and within that tax year. The problem with that is the second you hire somebody to help you with that property, you're back to test 2, which is 100 hours and more than anybody else. So my thoughts are you're going to hit one of those 3 most of the time. You're going to do the 100 hours plus more than anybody else. So those are the 2 biggest hurdles to this tax strategy. We need to make sure that the average rental period is less than 7 days. And we need to make sure that we materially participate in the property to show the IRS that we have skin in the game and that we're not just sitting back and collecting a check. So let's run through an actual scenario of how this could play out so you can really see what the potential for tax savings is here. So here's an actual scenario of how this could play out so you can see the tax savings. Take somebody that's making 90 grand on a W-2, say that they're a manager at a department store. They have a short-term rental where the average rental period is what? Less than 7 days, and they materially participate. So remember, with tax and tax advisory and tax planning, it's very circumstantial. And it all surrounds itself around the facts and circumstances of your situation. So for this person, 90 grand of income, they have a short-term rental, it's on average rented less than 7 days, and they materially participate in that property. Now, they were able to drive, let's say, in this example, we have a $56,000 tax loss. Really quick, which this will be in another video, how did we even get to a loss? Well, with a rental property, you're going to have rental income and you're going to have expenses. Typically, after expenses, you'll make a couple hundred to maybe a couple $1,000s, right, of net income. Well, one last expense that you haven't talked about yet is depreciation. Depreciation is the Mac Daddy of real estate investors' tax strategies. And what this allows you to do is write off a portion of the purchase price against your rental income. So in this example, this taxpayer was able to take a huge depreciation deduction of, I think, about 60 grand and bring them down to a loss of 56,000. So you can see if you back out the 60 grand, they probably netted 3 to 4 grand on this property in cash flow. Remember, short-term rentals, you're going to make a little bit more cash flow a year. So at the end of the day, this person makes 90 grand and they lost 56 grand on paper. So they ultimately only will pay tax on roughly 45 grand. So in this example, you have somebody making $90,000 on a W-2, losing $56,000 here with their rental property. And when they can net those two together because they've passed all the rules, they're only paying tax on about $34,000 instead of $90,000. And so the tax bill would go from originally being about $19,000 on $90,000 to only about $5,000 on the $34,000. So you'll see that there's a difference of 15 grand or so in tax savings just on this one rental property. So then we're typically asked, well, could I do this with 2 or 3 rental properties? And the answer is yes. So there's math to this to where if you were to acquire enough rental properties or ones that are expensive enough to bring down your tax bill to zero, that is possible. It would just depend on the purchase price and how the numbers shake out for those specific rental properties, which is why you need a tax advisor there to help you figure this out to determine what your potential savings are going to be. Now, you know me, and I always like to plug things back to bookkeeping. So I want to say, as sexy as these tax strategies are and how helpful they can be, you will not be able to do any of this without good bookkeeping. So as a reminder to yourself, if you're going to go out and try to do these strategies, make sure that you have a good bookkeeper to help keep the books for the actual rental property. When you buy it, when you furnish it, the rents that you're collecting, the expenses that you have, so that we can come to what these numbers are supposed to be on a tax return and then strategize to see how can we get depreciation up to therefore bring down your overall income. And don't forget to subscribe to the channel and comment anything else that you want me to come on here and talk about tax-wise, and send this to a fellow short-term rental real estate investor so that they can help recognize tax savings too, or anybody else that you think could benefit from this. And as I said, there will be another video to talk about depreciation and cost segregation, which is how you're going to drive such large losses on your rental properties. Until next time, cheers.